Good morning. We are John Carroll University, and this is Jeff, Hunter, Dan, Joey, and myself, Cindy. Today we're here to introduce Poly1 Corporation based in Avon. With a current price of $32.40 and a target price of $38.03, there's an upside of 19.78%, including dividends. Throughout our evaluation, we could identify 3 pillars to support our recommendation: strong competitive positioning, significant growth, and strong operating performance. Therefore, we give Poly1 a buy recommendation. Poly1 is a specialty chemicals company located globally across all different end markets, including transportation, industrial, and building and construction. Although most of the revenue is generated in North America, they have relative exposure in Asia, Latin America, as well as Europe. Poly1 can be divided into 4 distinct business segments: distribution, which represents over 25 different suppliers; color additives and inks, referred to as CA&I, which offers customized color and additives concentrates; specialty engineered materials, SEM, which offers specialized polymer formulations; and performance product and solutions, PPNS, which offers specialized niche services. Across these 4 different segments, Poly1 offers over 35,000 different products. Already this morning, you probably used a Poly1 product, whether it's in the car you drove here in, the coffee you're sipping from, or the clothes you're wearing right now.
Thank you, Cindy. Diving into the macroeconomic outlook of the specialty chemicals industry, a rising demand for plastics can be seen. A globally forecasted compounding annual growth rate of 5.3% was placed on the industry through 2023. Poly1 can take advantage of this opportunity through the pursuance of international end markets ranging from rail, automotive, aerospace, and healthcare. With manufacturing and industry growing rapidly within emerging markets, Poly1 can continue to increase its exposure in Latin America and Asia. Although Poly1 faces fierce competition within this industry, it is able to differentiate itself through innovation, cutting-edge technology, and the ability to guide its customers through the full value chain process. Poly1 holds a strong competitive position due to its low bargaining power of buyers and its low threat of substitutes. Poly1's products are a necessity to the end markets that it serves. Along with this, not a single customer contributed more than 3% to Poly1's 2018 consolidated revenue. We believe there would be no adverse effect if Poly1 were to lose or to drop one of its customers. Regarding a low threat of substitutes, Poly1's customers have a very difficult time substituting Poly1 product. Many times, Poly1's products are seen as substitutes for building materials ranging from wood to metal. These forces give Poly1 a strong competitive and a strategic advantage within the specialty chemicals industry.
Thanks, Joey. In addition to a strong competitive position, Poly1 exhibits tremendous growth opportunities, facilitated by strategic bolt-on acquisitions, innovative product enhancement, and a Lean Six Sigma approach. Together, these strategies have helped the company increase its adjusted EPS year over year for the last 9 consecutive years. In addition, management has been able to increase its dividend payments to shareholders by more than 71%, while repurchasing approximately 600,000 to 1 million shares annually over the last 3 years. Poly1's most recent acquisition of Fiberline, its most expensive acquisition to date, has cost the company more than $120 million. However, management believes it will be immediately accretive to EPS, boosting revenues by more than $100 million in its first fiscal year alone. Synergies created by Poly1's acquisitions have boosted revenue throughout the company by more than 20% since 2016. And with a compound annual growth rate of 5.5%, more than 20 basis points above the industry average, Poly1 continues to demonstrate its ability to boost its top-line growth, primarily in its CAI and distribution segments. Moreover, as revenue continues to increase, capital expenditures becoming more normalized, reaffirming Poly1's operational efficiency and management's ability to continue these growth strategies. Lastly, Poly1 continues to beat its peer group, primarily in terms of operational efficiency in the areas of asset, inventory, receivables, and working capital turnover. And as a result, Poly1's been able to increase its earnings per share over the last 5 years.
Thanks, Dan. This brings us to our valuation. In order to calculate our target price, we used a 3-pronged approach: a total firm discounted cash flow, a sum of the parts discounted cash flow, and a relative valuation. Each of these approaches were weighted 50, 25, and 25% respectively. This model yielded a $38.03 target price, as well as a 19.78% upside, including dividend payouts. For our first approach, the total DCF model, we used a 5-year unlevered free cash flow to the firm model. In this model, we utilized an 11.95% weighted average cost of capital. To calculate this, we used the capital asset pricing model and a risk-free rate. We used the capital asset pricing model to find the cost of equity and a risk-free rate plus double B credit spread to find the cost of debt. Additionally, to find the terminal value at the end of the 5 years, we calculated a terminal growth rate by using the weighted average GDP growth of all of Poly1's geographic regions. Next, we used the sum of the parts discounted cash flow. We did this because we felt that it responsibly accounted for Poly1's extremely diverse business segments as well as its varying life cycles. To calculate free cash flow for each of Poly1's 4 business segments for the next 5 years, we looked at management expectations, industry forecasts, Bloomberg analyst reports, as well as historic growth rates. Similar to our total firm discounted cash flow, we used the same weighted average cost of capital and terminal growth rate for 3 out of 4 of the business segments. However, for SEM, Poly1's most immature segment, we used an EV to EBITDA exit multiple of 7 times in year 5, instead of using a terminal growth rate. Finally, we conducted a relative valuation. We looked at almost 100 specialty chemical companies in Poly1's industry and narrowed that pool down to 5 firms that are Poly1's closest competitors. We did this by looking at operational and capital structure similarities, as well as taking guidance from corporate management. We then used this peer group to calculate a purchase price multiple that accounted for Poly1's unique characteristics, as well as their high level of debt investment. We understand that this is a non-traditional relative valuation approach, so we also conducted an EV to EBITDA and an EV to EBIT relative valuation. And as you can see behind me, both of those models yielded buy recommendation prices.
Great, thank you, Hunter. To compare our previously discussed valuation methods, we compiled their results into a football field analysis. We also included the price results of our bull and our bear cases in order to test for sensitivity, especially to revenue growth forecasts. Based on our analysis of these price ranges, it's clear that our target price of $38.03 is appropriate. We continued our sensitivity analysis of our base case stock price based on both WACC and terminal value, as well as the sensitivity analysis of WACC based on beta and market risk premium. Our valuation methods are most sensitive to these 4 variables. To solidify our buy recommendation, we conducted a Monte Carlo simulation based on Poly1's closing price on February 5th of $32.40. The key assumptions built into the simulation include the random walk theory, as well as 21 trading days per month. Now, after running this simulation 10,000 times, we concluded that 67% of its results support our buy recommendation. In addition, through our assessment of management's discussion of their business, as well as our understanding of the industry, we assessed the key risks facing Poly1 and its stakeholders. The way that we analyze these risks is by looking at Poly1's relative exposure to each one, as well as the probability that each risk would significantly influence Poly1's business. We determined that Poly1's cyclical end markets, their ability to achieve and sustain their double-digit EPS growth plan, as well as rising freight and logistics costs, present the most notable headwinds to the company. However, fortunately, Poly1's substantial research and new product development capabilities, their commitment to their share repurchases and their strategic bolt-on acquisitions, as well as the speed and agility of their distribution segment, will allow them to combat each one of these forces.
Thank you, Jeff. Coming full circle, Poly1's strong competitive positioning, significant growth, and strong operating performance all support a recommendation to buy Poly1 at a target price of $38.03. Thank you, and the floor is now open for questions.
Well, I guess I'll start. Let me just first say, just really terrific job on your presentation and your materials. I mean, hard to imagine how they could be better. So really nice job.
Thank you.
And you covered really well a lot of the things that I was thinking about. But one thing that I was wondering how you think about is the financial leverage the company has. Is that something that I need to be mindful of, or how do you guys think of what's, the balance sheet and debt?
I we understand that Poly1 does have a high leverage. We did incorporate their leverage in our valuation model, and it still came up with a target price above the current price, which is what made us do a buy recommendation.
In addition, Poly1 continues to rely on mergers and acquisitions for its operational performance, and we're fully confident that they can, as long as they maintain that $200 million in revenue that they set aside for those acquisitions, they continue to perform in a positive manner.
If I'm unconvinced, what metrics would you use to convince me that I shouldn't be worried about financial leverage?
Well, to piggyback off of what Cindy said, their financial leverage, although it is much higher than a lot of their other peers, even though the specialty chemical industry is highly levered as it is, their high amount of leverage is priced into our model, especially in our weighted average cost of capital. We used a bottom-up business beta, so we took the average beta of all their closest competitors and then re-levered it using Poly1's specific debt-to-equity ratio. And additionally, the way we conducted our relative valuation, we used an equity and debt multiple. So it not only took into account their equity, but also their high level of debt.
I just had one thought on, since there's a lot of foreign exposure here, did the company bring back, because of the tax law changes, any earnings from overseas? And then, if so, is that what was used to buy back the stock? Funds brought back from overseas earnings, if they did do that.
So they have repatriated some of their cash, but we do not believe that it was used for the share repurchases. And they do have an active plan to account for the changes in tax reform and any other way that may affect them.
Do you know if it was very beneficial to the tax law change to be able to do that?
It didn't seem like they have any major ramifications on the company.
So one question with what is their capacity for future M&A if that drove growth previously? Are there balance sheet constraints where their cost of debt would materially go higher if they continue to lever their balance sheet? So, and then if they can't continue to do M&A and lever the balance sheet, what does that do to their growth rate?
As for opportunities in M&A, there are a lot of little companies in the specialty chemicals industry that allow for Poly1 to have opportunities for more mergers and acquisitions. So opportunities like that are plentiful.
They focus on their acquisitions in the $50 to $100 million price, and making sure that they stay within those guidelines, as well as purchasing it at 10 times EBITDA multiple will allow them to stay committed to that plan.
Okay.
And additionally, especially their distribution segment brings a lot to their top line. Although it's not one of their most profitability segments, it is one of the segments that helps them drive things like dividends, capital expenditures, and additional M&A.
I have one final thought on something. I noticed here on your investment risk chart.
Yeah, go back to the chart.
Yeah, that's the multicolored one. E4 was the environmental regulatory risk. And I see where you had a low probability of that probably regulations being put in place. Can you expand on that a little bit? I mean, all the publicity now is anti-plastic and anti-this relative to specialty chemical type things. Why do you feel the probability is so low in a middle of the road kind of exposure?
Sure. So the way that we looked at this is that they have an environmental reserve set up for past contaminations of sites that they've worked at at approximately $103.3 million. This is in line with their with the EPA's calculation of this reserve, and we think that based on the setup of this reserve, as well as the decline in some of these costs over the past year or so, based on those hazardous sites that they may have contaminated in the past, that they tend to have it under control, and that the likelihood of something major impacting that reserve in the future is pretty low.
Going off what Jeff said, as of the most recent earnings call, they're actually a founding member of what's called the Alliance End of Plastic Waste. And that is to contribute and continue to clean up the environment along with meeting EPA regulations. And as we have seen, I believe starting in 2016 to 2018, there's been a drastic decrease in their environmental remediation costs.
Furthermore, they work very closely with the EPA to always make sure that they're up to date in terms of regulation and that they're forward looking in terms of ending plastic waste.
So they're being proactive more or less, as
Absolutely.
opposed to
Yes.
just burying their head in the sand
Yes.
and hoping to go away.
Yes,
Absolutely.
correct.
With your valuation inputs, you have assumptions for growth, earnings, and top line. Did you model things like earnings and margins and things to come up with the inputs for the valuation models?
Yes, we looked at on both our total firm discounted cash flow and our sum of the parts discounted cash flow. We used, as I said, a 5-year unlevered free cash flow to the firm model. So we started with revenue, took out expenses, ended with EBIT, added back depreciation, amortization, and less changes in net working capital, and then used things like Bloomberg analyst reports, management expectations, and industry forecasts to be able to forecast both margins, revenues, and depreciation and CapEx.
This is also about midway through the appendix if you wanted to be able to see it right in front of you.
Okay. Yeah, I realize there's only so much time you have to show on the
Right.
slides. Yeah. So do you think margins, the company's done a nice job, admittedly, right? Their earnings have gone way faster than the revenues, right? So margins have gone up. Do you think margins continue to go up, or is that a risk? Are we at a cyclical peak for margins, do you think?
It's certainly a risk to the company, but they continue to beat analyst estimates, particularly in terms of revenue and adjusted EPS. So we're confident in their ability to continue doing so.
Yeah, and they're reluctant. They're going with their acquisitions, their constant acquisitions. They look for cost synergies within those acquisitions, and those are continuing to push down costs, which allow for greater margins and safe margins, we believe.
And to piggyback off of that, September was a really tough month for this industry with rising raw material costs in polypropylene, polyurethane, and especially nylon, and rising logistical costs, as Jeff talked about in the presentation. So that may have been the cyclical trough for the industry, and they actually ended a little over flat for Q4. So Q1 is expected to be slightly better than Q4, and then historically Q2 is their best quarter. So we anticipate 2019 being slightly better than 2018 as a whole.
So going through some of their analysis, they have a substantially lower EBITDA margin. Granted, the trend, as Paul mentioned, may be on the right trend that led to higher EPS growth. Some of these competitors, like Ashland, Celanese, they have substantially higher EBITDA margins. Poly1 more in the commodity chemicals relative to their peers. What drives that difference?
Pure valuation slide.
Yeah, so I'm looking at appendix G. That's
Yeah.
where I got it. Yeah.
So one of the things that Poly1 does differently from its competitors is that they offer comprehensive service from the beginning of the value chain all the way through. So, in terms of their peer valuation, Poly1's highly differentiated in that regard. So we believe that will certainly offset their margins in that area.
Okay. And then, so in some of the valuations that are multiple driven, how do those multiples relate to the peer average?
In terms of like EV to EBITDA?
Yeah, EV to EBITDA.
Yeah, so currently their peers, at least the peer group that we constructed, they're trading around 10, 11 times EBITDA, while Poly1's trading at about 9.
Mm-hmm.
So with that multiples valuation, that put Poly1's price at a little bit above $36 using EV to EBITDA.
Okay, and I'm sorry, what again was that multiple you used to derive the valuation on the EV to EBITDA? So you drive your target price on that particular valuation method. What multiple did you assume?
We took the median EV to EBITDA multiple for their closest competitors.
Okay.
And then multiplied it by Poly1's trailing EBITDA for 2018.
Gotcha.
And then took out total debt and capital leases.
Okay, great.
To get
Thanks.
to implied intrinsic value.
All right, that's your guys' time. Thank you.
Thank you guys.
Thank you.
Thank you.